We've continued to see markets grind higher during the course of this week, with the FTSE 100 in particular just pushing out above the top end of its recent trading range. And further in the US, the S&P is looking quite close to recording one of its best starts to a financial year, or certainly a January performance seen for over 10 years. So the mood is still towards the positive side. And during the course of the week, we've had developments in the US where the Fed, the central bank of the US, were referring to their longer term outlook, and they have originally said that they will keep rates accommodative and low, exceptionally low, through to the mid part of 2013, but that's now been extended to the end of 2014, and that move in itself gave the US markets quite a strong blip up. Here in the UK, we've had two key bits of data. The first is that the national debt has now risen through the 1 trillion level. 1 trillion sterling. Indeed, the monthly deficit was slightly better than expected, but it's still continuing to compound, and as I say, through that key level. And secondly, we had the advanced reading of UK GDP in the fourth quarter. Forecast was for a small decline of 0.1%. It came in at 0.2% for the quarter. So the economic backdrop for the macro picture, would say still remains under some pressure. Indeed, the IMF has also weighed in this week with quite a severe downgrade to world economic growth. In particular, they're looking at Europe, and they've managed to scale back expectations right across Europe. And I think as we go through 2012, there are two issues to really look at. One is the shorter term considerations of how to finance the debt. The longer term implications, and I think possibly the more pressing issue, is going to be about economic growth and how economic growth can be stimulated in the Western world again. Of course, overhanging all of this, we are coming very close now to what is going to happen with Greece. The deadline is fast approaching, and as yet no resolution, albeit that it appears that the sides are coming closer together towards some sort of resolution to Greek debt. And I suspect we'll be talking more about that next week, particularly with the European summit that is due on Monday. So a quick look at some of the charts. The FTSE 100, as I say, just sort of pushing through the top end of the range. Just two other charts I want to show relating to markets, just to show where some of the trends are. On this busier chart, what I've tried to highlight here is the FTSE performance relative to the FTSE 250, and then going further down the small cap list into the all share index, and also into the AIM index. And whilst, as I mentioned, the FTSE 100 has started the year well, where the real action has really been more in the FTSE 250, where the year-to-date performance at the moment is running at a much faster rate. So that's the implication of that is that there's money coming through for more riskier assets as the mood is turning more positive, and so the smaller you go, it tends to be the better the performance that's coming out of markets. Just standing back, looking more at the global picture, I think this is an interesting chart just to assess what is going on in the world. And this chart goes back to just prior to the financial crisis, in how different regions have managed to cope with the crisis. And we can see here that through to 2009, the US stock market, as represented by the S&P, relative to the Euro stocks market, which represents the larger companies in Europe, really ran very close to each other. But it's how the crisis has been dealt with is really quite observed how the S&P is significantly outperforming Europe, and you can argue here quite clearly as to the different ways of dealing with the crisis. At the moment, it's the US that seemingly is coming out of this much better, and that is being reflected in the relevant stock markets. It has been part of the reason why we have been more and more increasing international exposure and away from domestic and European exposure during the course of this time. If you do look at some of the stocks that are performing, obviously Apple is always a stock that you put into the camp of an outperformer at the moment. Expectation for the last quarter was $38 billion of sales. They came in at $46 billion, so it's a huge beat. And the shares, even though they've been a superb performer over the course of the last few years, even managed to pop up about 7% on the back of that announcement. Just really coming back to Europe, because whilst Europe has certainly not had too much attention this week, that European summit next week is going to become relevant again as to what is discussed. In the past, these summits have tended to promise a lot and deliver less, but nevertheless, I think it will be on the agenda. We've concentrated on currencies. Last week, I did mention that the euro was rallying. High levels of short positions in the euro means that when it rallies, it is squeezing higher and getting the bearish currency traders to possibly cover shorts at this level. So there's been a continuation of the euro rally against the dollar, which is pleasing to bring it back into mid-range. And also, if we look at the pound, on the back of the announcement this week on the monthly budget deficit, which coming in better than expected, indicative of maybe this austerity drive in the UK still keeping on top and bringing forward that date where hopefully they can look at a monthly budget surplus. So sterling still in favour, and that has managed to sort of again move back up to 157. So whilst there is all this positive sign, just we need to keep an eye on the European bond markets. I think it's worth highlighting Portugal. Portugal is behind Greece, the most concerning of the European countries, and we've now seen yields on their 10-year paper now rising. It's been touching 15% this week. It's worth reminding that Greece 10-year paper went through 15% only in August of last year, and over the course of the last 4 months has gone from 15% up to 33%. So there are obvious similarities here with Portugal, that it's on a spiral that could rapidly rise, and so therefore we need to keep an eye on Portugal. But of more encouragement has been that the major economies of Italy and Spain, that we have seen the continuation of yields falling in Italy. This is moved down from over 7% to touching around 6%. Indeed, it has dipped below 6% in the course of the last week. So still too high for the long-term economic position of Italy, but that trend is really partially the reason as to why more money is heading into equities and risk assets, and a trend that's likely to continue for the next few weeks.